Hi everyone, my name is Andrew, and today I'm going to go over the business entities, commercial paper, and secured transactions questions from our multiple choice Q Bank for the Florida bar exam. I had some tech issues with the class this morning, so I'm re-recording this. It's just me here tonight, and I'm gonna have a good time. So you can access these questions on Birdie. This is our question bank we have one for the Florida bar, for the MBE, for the LSAT, for the SAT, and we're building one now for the next gen bar. So Birdie is our website where you fly through standardized testing from the SAT to the bar exam, soar ahead and test prep, all those great winged metaphors to get us started. So let's begin. Which of the following is not a requirement for a valid partnership under Florida law? At least two persons, a written partnership agreement. That's going to be the answer. You don't need a written partnership agreement. It can just be uh, two people doing business together for the purposes of a profit. There's no need for a written agreement for a partnership. Under Florida law, what is the default rule for partnership profits and losses? Sharing in the absence of a partnership agreement. So in the absence of an agreement, sharing of profits and losses will be equal. That's the rule for partnerships. In Florida, which of the following statements regarding LLPs is false? So three of these are true. An LLP must file a statement of qualification with the Florida Department of State is true. An LLP must obtain an EIN number, true. All partners in an LLP have limited liability for partnership obligations is true. And then this statement is false. An LLP partner is not personally liable for their own malpractice. They will be liable for their own malpractice, just not the malpractices of others in an LLP. Which of the following statements about business entities in Florida is false? In a general partnership, all partners have equal rights to the management and conduct of the partnership business. That's true. In an LLC, members are generally not personally liable for debts and obligations. That's true. In an LP, both general partners and limited partners have equal rights to participate in the management of the business. That's going to be false because limited partners don't manage the business. They're just capital contributors. In a corporation, shareholders have limited liability for the corporation's debts and obligations. That's true. So the false statement is that limited partners have management responsibility in a limited partnership. Only the general partners have management obligations in a limited partnership. Under Florida law, which of the following statements about a partner's fiduciary duties in a general partnership is false? The duty of loyalty includes the obligation to account for profits derived from the use of partnership property is true. The duty of care requires partners to act with the care an ordinarily prudent person would exercise under similar circumstances is true. The duty of loyalty includes the obligation not to compete with the partnership is true. And the duty of care requires partners to indemnify the partnership for any losses caused by their intentional misconduct is going to be false. They're not required to indemnify the partnership for losses that stem from intentional misconduct. Which of the following business entities in Florida requires a registered agent to be identified in formation documents? That would be a corporation. In the articles of incorporation, you have to identify a registered agent. Under Florida law, what's the minimum number of directors in a corporation? Only one. You only need one director in a corporation. Which of the following is not a requirement for the issuance of shares in a Florida corporation? Authorization in the articles of incorporation you need. Consideration received by the corporation is necessary. Compliance with security laws and regulation is necessary. You don't need a resolution by the board of directors. They usually have one, but it's not legally required for validity. Only these three things: authorization, the AOI, consideration received by the corporation, and compliance with securities laws and regulations are truly needed. It's going a lot smoother than it went this morning. In a Florida corporation, which of the following statements about cumulative voting rights is false? So cumulative voting must be provided in the articles of incorporation. True. Cumulative voting rights allow shareholders to cast multiple votes for a single director nominee. That's true. It benefits minority shareholders. That's why they're saying it enhances minority shareholder representation. That's true. Cumulative voting rights are mandatory for all corporations in Florida. No, they're elected. You can have cumulative voting or straight voting. And if you have cumulative voting, it benefits smaller investors because they can stack their votes for one chair. Under Florida law, which of the following actions requires approval by a majority of the corporation's disinterested directors? So disinterested directors are going to need to vote for a conflict of interest transaction. That's what disinterested means, that they don't have any interest in a transaction. So the interested directors would be sequestered and the disinterested ones would vote to approve this conflict of interest transaction. In Florida, which of the following does not fall into the business judgment rule? Decisions based on reasonable reliance on expert advice, decisions made in the best interest of the corporation, decisions made in good faith. Yes, those are all protected under the business judgment rule, the BJR, but not decisions based on intentional misconduct. The business judgment rule will not protect decisions based on intentional misconduct. Which of the following statements regarding the indemnification of directors and officers in a Florida corporation is false? Mandatory indemnification is provided when an officer is successful in defending a claim against them. True. Permissive indemnification may be provided if a director or officer acted in good faith in the best interest of the corporation. Is true. Indemnification is limited to the amount of actual expenses incurred by the director or officer. Is true. A corporation must always indemnify a director or officer regardless of their conduct or the outcome of the legal proceeding. That's not true. If they're not successful or if their conduct is intentional, then they're not required to indemnify a director or officer. Especially in cases involving misconduct or liability, the corporation is not required to indemnification. Under Florida law, which of the following statements about a corporation's right to inspect its shareholders list is false? Shareholders have the right to inspect the corporation's shareholder list. Is true. The shareholder list must be made available at the corporation's principal office. Is true. Shareholders must have a proper purpose to inspect the shareholder list. Is true. The right to inspect the shareholder list is not subject to any restrictions. Is false. It is subject to restrictions. It has to be reasonable. They have to have a proper purpose. They can't just ask to inspect on a Sunday at 2 a.m. for no reason, right? Which of the following statements about shareholder voting in a Florida corporation is false? A simple majority of shareholders is typically required to amend the articles of incorporation. True. A simple majority vote of shareholders is typically required for the approval of a merger consolidation. Is true. A simple majority vote of shareholders is typically required for the dissolution of the corporation. A supermajority of shareholders is always required for amending the articles of incorporation, approving a merger consolidation, and dissolving the corporation. That one's going to be false. You need a simple majority for amending the AOI, for a merger consolidation, or for a dissolution of the corporation. That would need a shareholder vote, right? A and B are shareholders. A owns 45, B owns 55. Andrew believes that Brian is engaging in fraudulent behavior that's harming the corporation. Which of the following is not a step Andrew should typically take to initiate a derivative lawsuit? So derivative lawsuits are suits on behalf of the company. Andrew should make a demand on the board of directors to address the issue. True. Andrew should file a complaint in the court in the name of the corporation. True. Andrew should sell his shares to Brian before filing a lawsuit. That's not true. You need to have shares at the time of the alleged misconduct, and you need to have shares when you file the suit. So you wouldn't want to sell your shares. Andrew should be a shareholder of the corporation at the time of the alleged wrongdoing. That's definitely true, but you shouldn't sell the shares before filing the lawsuit, or you would lose your ability to bring the claim. Which of the following statements about the rights of members is false in LLC? Members have the right to vote on certain major decisions. True. Members have a right to share in the LLC's profits and losses. True. Members have a right to manage the LLC directly. True. Members have the right to freely transfer their membership interest without the consent of other members. That's not true. You need the consent of other members of the LLC to transfer your membership interest. We assume in Florida and in all jurisdictions that LLCs are member managed, but the LLC could elect to be manager managed and hire managers that will run the company. But here we assume it's a member managed LLC, and in order to transfer interest, you need the consent of the other members, unless the operating agreement specifically allows it. This restriction protects the close-knit nature of LLCs and preserves management control among existing members. A and B formed a general partnership in Florida, and they drafted a partnership agreement. After a year, Brian decides to leave the partnership. Which of the following is true about Brian's ability to dissociate from the partnership? Brian cannot dissociate from the partnership because there's no written partnership agreement. Is false. Brian can dissociate from the partnership at any time, but he may be liable for damages if the dissociation is in breach of the partnership agreement. That's a true statement of law. You can dissociate at any time, but if it causes the partnership damages, then you'll have to pay for them. Which of the following business entities in Florida does not require the filing of an annual report with the Florida Department of State? Corporation, LLC, LP, or GP. A GP doesn't require a filing. All of these more sophisticated entities will require a filing, but not a general partnership. IBIS Inc. is a California corporation transacting business in Florida. Until it obtains a certificate of authority to transact business in Florida, which of the following activities is IBIS prohibited from doing in Florida? Maintaining a proceeding in any court in Florida, defending a proceeding in any court in Florida, obtaining orders by mail from Florida residents which require acceptance in California, or selling its products to independent contractors in Florida. So you're not going to be able to maintain a proceeding until you have your articles, until you've obtained a certificate of authority to transact business in Florida. You cannot maintain a proceeding. You can only defend yourself or start doing minimal sales in the state. But until you've obtained the certificate of authority, you cannot sue anyone. You cannot maintain a lawsuit. You can only defend yourself if you are sued. Under Florida law, which of the following statements about a general partner's liability in a limited partnership is false? A general partner is personally liable for partnership obligations. True. A general partner's liability is limited to their capital contributions to the partnership. That's false, right? Because a general partner's liability is personal. It goes beyond just their contribution. That's a limited partner who has limited liability. A general partner has unlimited liability. Which of the following actions does not require the unanimous consent of all partners in a Florida general partnership? Admissions of a new partner? It does. Approval of a merger or consolidation? It does. Dissolution of the partnership? No. Amendment to the partnership agreement? Yes. Dissolution of the partnership, I mean, if it's two partners and one wants to dissolve it, then they would be able to do that without unanimous consent, right? So most major decisions in Florida general partnership require unanimous partner consent, especially those affecting ownership or structure. However, dissolution can typically be approved by majority unless otherwise stated in the partnership agreement, right? If there's three partners and two want to dissolve, that would be enough. But for admission of a new partner, a merger, consolidation of a partnership, or amendment to the partnership agreement, you need unanimous consent. Now, this is different than like a corporation, which would only need a 50% vote from the shareholders, but this is a partnership where you need unanimous consent for something that would affect major decisions of the partnership. Under Florida law, which of the following statements about the dissolution of a general partnership is false? So dissolution occurs when the partnership's term is expired or when the partnership has completed the particular undertaking or project for which it was formed. True. Dissolution is the result of the completion of the winding up process, including selling the partner's debts and distributing its assets. That's false. Dissolution is the start of the process, followed by winding up, followed by termination. So here we'll have dissolution, winding up, and then termination is the proper order, right? In a Florida corporation, which of the following is not a permissible method for a shareholder to vote? In person at a shareholder meeting? True. By proxy? True. By written consent? True. By telephone? No. You can't vote by telephone. You could vote by proxy, which could be a written or electronic authorization to have someone vote on your behalf, but you can't just call in your vote. Sarah White is an operating partner, while John Brown is a dormant partner in a general partnership known as Sarah's Fresh Bakery. After 4 years of non-involvement in the business management, John purchased 500 bags of flour for the bakery. Sarah's upset because it will likely take a significant time to utilize such a large amount of flour and seeks your advice. Well, here, John is a silent partner and he will be able to bind them. Despite his dormant status, John can commit the partnership through his action. Definitely. That's going to be a common answer where one partner can bind the partnership, even if they're a dormant partner. P's sole assets, so our collection of high-tech devices currently in disuse. One of its members is approached by an interested party wishing to purchase all the devices. Because it's their sole assets, this would be a liquidation event. So we're going to need a majority vote of shareholders eligible to vote must approve before they can proceed with the sale of the devices, because liquidation does require a majority vote of shareholders in a corporation. Jim Anderson borrowed $300,000 from Steve Martin to open a bookstore. Steve's only concern in the business was the repayment of a 6-year unsecured loan. In gratitude for the loan, Jim named his business Anderson and Martin Books and bought signs and advertising showing his name. He also listed Jim Anderson and Steve Martin as partners on his business card. When Steve found out, he was so pleased that he voluntarily decreased Jim's interest rate from 10% to 9% per annum. A few weeks later, Jacob Thompson, who assumed Anderson and Martin worked together and had no knowledge of the true situation, sold books to Anderson and Martin Books. Jake has been unable to collect for the books and seeks your advice. What is the most likely true statement? So only Jim Anderson is liable? No, both Jim and Steve are jointly liable because there's enough information here to suggest that the third party would believe that both of these people are partners, and therefore we have a partnership by estoppel because they hold themselves out to be a partner and can be held jointly liable for the debts of the business of third parties. Which of the following is not a duty of the board of directors in a Florida corporation? Declaration of dividends, approval of major corporate transactions, election of officers, or day-to-day management of the corporation? So it's going to be day-to-day management of the corporation. That's what the officers do. The board of directors elect the officers who manage the corporation, but the board of directors don't manage the corporation themselves. In a Florida LP, which of the following statements about the rights and duties of limited partners is false? A limited partner has the right to inspect the partnership's books and records is true. A limited partner has the right to vote on certain major decisions. True. A limited partner has a duty to contribute capital to the partnership is true. A limited partner has the duty to manage the partnership's business is false. The limited partner doesn't manage the business. That would be the general partner who manages the business. Which of the following states about ultra vires acts in Florida corporations is true? Ultra vires acts are acts that corporations specifically authorized to perform. No, it's acts that go beyond their authority. Ultra vires acts are acts that go beyond their powers, but are still legally binding. That's not going to be true because the truth is they can render the contract voidable. Ultra vires acts are acts that are beyond the corporation's powers as granted by its articles of corporation, and they can render a contract voidable. Definitely the best answer for that one. Ultra vires acts exceed a corporation's legal authority, and they can be challenged or voided. Which of the following is not a requirement for a valid corporate merger or consolidation under Florida law? Approval by a majority of the board of directors? Yes. Approval by a majority of shareholders? Yes. Filing articles of merger consolidation with the Florida Department of State? Yes. Obtaining a certificate of authority from the Florida Department of State? No, that's for foreign corporations to conduct business in Florida. That's not for a merger consolidation. So you wouldn't need that. You would need to approval by the board, shareholder approval, and filing the articles of merger consolidation are the three steps. In a Florida corporation, which of the following statements about the appointment or removal of officers is false? Officers are appointed by the board of directors. True. Officers serve at the pleasure of the board of directors. True. Officers may be removed with or without cause by a majority vote of shareholders. False. Officers may be removed with or without cause by the board of directors. So think about it like this. The shareholders elect the board of directors. The board of directors elect the officers. Officers serve at the pleasure of the board of directors. The board of directors serve at the pleasure of the shareholders. So shareholders are not the ones who appoint and remove officers. The board of directors appoints and removes officers. The Articles of Incorporation for Super Prime Corporation empowered its board of directors to perform any action as permitted by law. Which of the following moves by the board of directors also requires the consent of the shareholders of Super Prime Corporation? Extending the lifespan of Super Prime if it was founded during a period when limited duration was legally required. Merger with another entity. Yes, merger will require a shareholder vote, right? Altering the name or modifying the par value, no. Mergers, acquisitions, consolidations, stock splits, voting for the board of directors, amending the articles of corporation, all these fundamental changes will require a shareholder vote. Under Florida law, which of the following statements about a partner's authority to bind a partnership is false? A partner has the authority to bind the partnership in the ordinary course of business. True. A partner's authority to bind the partnership is actual and apparent. True. A partner's authority to bind the partnership extends to transactions made outside the ordinary course of business is false. You can only bind the partnership for ordinary business dealings, not transactions outside the ordinary course of business without unanimous partner consent. A single partner cannot unilaterally commit the partnership to major or unusual obligations. Tom and Sally established an LLC and are the only members. Tom contributes a parcel of real estate to the LLC and Sally contributes $200,000. What is true? So who owns the property? The LLC. The LLC is the exclusive owner of the real estate and any property that's bought with the money, right? That's why people set up LLCs often, is to put, land purchases in the LLC so they can be shielded. Let's say if, there's a slip and fall on the property, they would have to sue the LLC and not the individuals who are members of the LLC. So think about that an LLC will own the property on its own. Williams and Thompson had plans to establish a Florida corporation to operate a bike repair shop. No documentation has been submitted to the Secretary of State regarding the corporation when Williams and Thomas started to buy tools needed for the bike repair business. They jointly executed and delivered a $15,000 promissory note to vendor in the name of Bike Fix Inc., signed by Williams as president and Thompson as secretary of the non-existent corporation. So here they're holding themselves out as a corporation. There was no personal guarantee by either Williams or Thompson on the note. The corporation was never created. Thompson moves for a motion to dismiss, claiming he should not be held personally liable. He will be held personally liable because he signed the note intending to act on behalf of the corporation while knowing it didn't exist. It's not that there's a corporation by estoppel, because it's not saying that a third party, believed that they were a corporation. It's saying that they were purporting themselves to be a corporation. So here, it's a promoter liability. They're personally liable for contracts made on behalf of a corporation that has not yet been formed. Signing in an officer capacity does not protect them from liability if the corporation never comes into existence. So here, they're pretty much promoters who are acting on behalf of a non-existent corporation, and they'll be personally liable for obligations entered into before the corporation is legally formed. This is known as promoter liability. M, O, and L formed a member-managed LLC. On March 1st, Leo dissociated from the LLC. A year and a half later, Leo sent a demand letter to LLC seeking to review the LLC's prior year's federal income tax return. In his demand, Leo provided 10 days notice to review the records at the physical address of the company at 1 p.m. The LLC refuses to provide Leo with this information. What is the best argument? The best argument is he's been out of the LLC for a year and a half, and he wants to see their prior year's return. Well, there's at least half a year where he was not a part of the LLC, so the records wouldn't pertain to a time period when he was a member. So the tax return does not pertain to the time period when Leo was a member. Certainly the best answer. Clearwater Inc., a Florida corporation, is electing new members to its board of directors. Among the following nominees, who's not eligible? It's going to be a 17-year-old, right? You have to be an 18-year-old natural person. You don't have to own shares of the company, and you don't have to be a Florida resident, but you have to be at least 18 years old and be an actual person, like an individual person. You can't be a director if you're a corporation or a partnership. You have to be an individual person, at least 18 years old. Seaside Inc. is a newly formed Florida corporation. In accordance with Florida law, which of the following must be included in its articles of incorporation and subsequent annual report? So the name of its initial registered agent and the street address of the corporation's initial registered office in Florida and the articles of incorporation, and both the street address of its registered office and the name of its registered agent and its annual report. Right? You need to have all these things in the articles of incorporation and in the annual report. Florida Corporation must include the registered agent's name and registered office address in both its AOI and annual report. Under Florida law, which of the following statements about the liability of a promoter of a corporation is false? A promoter is personally liable for pre-incorporation contracts made on behalf of the corporation. That's true. A promoter's liability for pre-incorporation contracts is limited to capital contribution. No, they have personal liability. A promoter's liability for pre-incorporation contracts can be assumed by a corporation. True. A promoter's liability for pre-incorporation contracts is joint and several with other promoters. True. But they're going to have unlimited liability, not just limited liability. So promoters are liable before the corporation comes into existence, and they stay liable after the corporation comes into existence unless there's a novation where the corporation solely takes on liability. But think about promoter liability. They're liable before the corporation exists, and they stay liable after unless there's a novation. Oceanview Inc. is a Florida corporation owned by Mr. White. Consider the following scenarios below. In which of the following scenarios is a court most likely to pierce the corporate veil and hold a person liable? So piercing the corporate veil means there's been improper purpose, or there's misconduct. There's some thin capitalization or alter ego, or some argument to go directly after the board of directors or go directly after a parent company of a subsidiary. There has to be some improper purpose, some misconduct, some showing that they were a conduit for malfeasance. So Mr. White regularly fails to hold annual shareholder meetings. He uses corporate funds for personal expenses and to pay personal debts. That's definitely an improper purpose. They haven't made a profit over the last 2 years. Mr. White has made a bad business decision. So this is probably going to be protected by the business judgment rule. Hey, there's a lot of businesses that don't make a profit. Be wary before you go into business, or you might end up recording videos in the middle of the night because you got to do what's best for your business, even if it's not in the best interest of profit. But yeah, if you're using corporate funds for personal expenses and to pay personal debts, that would be an improper purpose, which would be reason for piercing the corporate veil. It requires a showing of improper use of the corporate entity, like commingling funds, fraud, or using the corporation for personal debts. Just being sloppy or making bad decisions is enough. Courts protect the corporate shield unless it's abused. Suntech Inc. is a Florida corporation. In January, a shareholder gave a proxy to another shareholder to vote on her behalf in the upcoming annual shareholders meeting in March. Unless otherwise specified, when will this proxy expire according to Florida law? So proxies are going to last 11 months. So we were here in January. We're going to go into the following December. And that would give an 11-month time period for the proxy. They expired 11 months after execution. And a Florida corporation, which the following statements about shareholder meetings is false. Shareholders have the right to call a special meeting if they have at least 10% of the voting power. That's true. Control stock. Notice of a special meeting must be given to shareholders at least 10 days before the meeting is true. A quorum for a shareholder meeting is a majority of the outstanding shares entitled to vote. Also true. So all the statements above are true. A quorum typically is the amount of shares necessary to hold a vote. And unless stated otherwise, it's going to just be a majority of the outstanding shares would constitute a quorum. Sunshine LLC, a Florida-based company, is planning to issue new securities. In accordance with Florida Blue Sky laws, what's the main requirement that Sunshine LLC must comply with before issuing these securities? So I remember when I took the Florida bar exam, they did ask me a question about Blue Sky laws. Blue Sky laws mean intrastate securities. They're only sold within the state of Florida, not interstate. So Sunshine LLC must register these securities with the U.S. Securities Exchange Commission. That's false because that's for interstate securities. That's, the Act of 1932 and, new issues in the United States, not within one state. They must register these securities with Florida's Office of Financial Regulation. Yes, Blue Sky laws are going to be intrastate, so Florida's office, not the U.S. office. That's going to be the law with Blue Sky laws. They're intrastate securities. Under RUPA, if there's no agreement specifying otherwise, how are partnership profits shared among the partners and how are losses allocated? Profits and losses are shared equally among partners if there's no agreement otherwise. What's required to create a voting trust in Florida? Signing an agreement by one or more shareholders and transferring the shares to the trustee. Yes, you create a voting trust by signing an agreement, transferring your shares to the trustee, and then you're all going to vote in unison as part of the voting trust. When a partner retires from a partnership, what is their liability for obligations incurred by the partnership while they're a member, unless certain conditions are met? So they're still going to be liable while they're a member. So they remain liable for all obligations incurred by the partnership while they were a member of the partnership. That's true, right? Obligations that were incurred after they were a member, they won't be liable for, but they remain liable for all obligations they incurred while they were a member, unless there's a release payment or novation absolving that liability. ABC Corporation is elected to be treated as an S Corp under Florida law. Which of the following statements is true regarding S Corps? So an S Corp is kind of like an LLC. It's just a top-down approach instead of a bottom-up approach. Think about that. An LLC starts as a partnership or a sole proprietor and then elects to have limited liability. So it starts with flow-through taxation and elects limited liability to have that nice combination of limited liability and flow-through taxation. An S Corp starts as a corporation that has limited liability and double taxation, but it elects flow-through taxation. So an S Corp has limited liability and elects flow-through taxation. So S Corps and LLCs arrive at the same point, limited liability and flow-through taxation. So S shareholders are personally liable for debts and obligations? No, but the profits and losses are passed through to them on their individual tax returns. That's what flow-through taxation means, that they avoid double taxation by passing income and losses directly to shareholders. ABC Corporation has issued cumulative preferred stock to its shareholders. So that means that when dividends are declared, preferred shareholders need to be paid this year's dividend payment plus any payments in arrears that were missed. So cumulative preferred stockholders are entitled to receive dividends before common stockholders, and any unpaid dividends accumulate and must be paid in future years. That's absolutely correct. They're going to get payments in arrears in addition to the current dividend payment. Remember, preferred shareholders mean dividend priority and liquidation priority, but they don't have voting rights like common shareholders unless it's something that's going to impact their class. Like if they're going to introduce a new type of shares that have, let's say, dividend rights above preferred shareholders, then you would need a majority vote of preferred shareholders. But otherwise, preferred shareholders do not have the right to vote. Under Florida law, which of the following is a factor that a court may consider when deciding whether to pierce the corporate veil and hold individual shareholders personally liable for a corporation's debts and obligation? The number of shareholders, the size of the corporation's annual revenue, whether company commingled personal and business funds, right? Improper purpose would be the reason for piercing the corporate veil. And then finally, in a company liquidation, which of the following parties typically has junior priority in receiving payment from the remaining assets? Shareholders, employees, secured creditors, or unsecured creditors. So junior liquidation priority will go to common stockholders. Shareholders are the last ones. The first ones to get paid out are going to be taxes and wages. Then we'll pay secured creditors, then unsecured creditors. And at the end, we'll pay shareholders. Preferred shareholders will get paid out before common shareholders. Common stockholders will have junior liquidation priority in the event of a liquidation. So pretty solid. It's interesting how smoothly I go through this without having a class in front of me, but I know I went quickly, so highly encourage anyone who's watching this to do these questions by themselves, and hopefully you can learn a lot. I'm going to do the secure transactions and commercial paper ones as well. We'll see how it goes. So which of the following is true regarding a security interest under Article 9 of the UCC in Florida? A security interest is a property interest in collateral that secures payment or performance of an obligation. That's definitely true. It's a collateralized agreement. It's not a lien on real estate or anything like that. It's collateral that can be tangible or intangible, and the tangible types of collateral are consumer goods, farm products, inventory, and equipment. Which of the following is an example of the type of collateral that can be subject to a security interest under Article 9 of the UCC? A debtor's interest in LLC, a debtor's goodwill, a debtor's right to receive payment from a customer for goods or services sold, or all the above. Any one of those three would constitute valid collateral. Which of the following is true regarding attachment of a security interest in collateral under Article 9 UCC? Attachment creates a security interest that is enforceable against the debtor. Attachment automatically perfects a security interest. No, that's perfection. Attachment requires a written security agreement signed by both parties. Attachment can only occur if the collateral is tangible. That's not true. I'm going to say A here because usually you need a written security agreement, but not in certain types of collateral where you can use possession or control. So yeah, I like A as the true statement, and C, no, because it could be possession or control of certain other collateral. But you attach by giving value, having rights in the collateral, and then authenticating a security agreement, or via possession or control of certain types of collateral. B operates a business selling electronics and needed funds to enhance the shop's facilities. B produced a $60,000 loan from Finance Corp. The pair signed an agreement that listed all of B's assets as collateral for the loan. B used a pen for signature while Finance Corp used a digital signature. We don't care about the signatures, but all of B's assets is not going to be sufficient to in a security agreement. It might be sufficient in a financing statement, but it's not going to be sufficient in a security agreement. You need to reasonably identify the collateral in a security agreement. Which of the following is true regarding perfection of security interest under Article 9 UCC in Florida? So perfection creates a security interest that is enforceable against third parties. True. Perfection requires the debtor's consent. No. Perfection automatically occurs upon attachment of security's interest only if it's a PMSI in a consumer good. Perfection requires a secured party to take possession of the collateral. No, you can file a financing statement. But what perfection does do is put others on notice of the interest. Which of the following is an example of a type of collateral that can be perfected by possession under Article 9 of the UCC in Florida? Inventory, accounts, promissory notes. So inventory, I think, is too large. Accounts, I think, would be control. Promissory notes, I think, would be possession. Yeah, tough question, but promissory notes by possession. Which of the following is true regarding the priority of security interest in collateral under Article 9 UCC? A perfected security interest always has priority over an unperfected security interest. Yes. Unperfected has priority over perfected. No. The first party who attach has a security interest in the collateral has priority over later parties who attach security in the same collateral. No, it's about who perfects first. All security interests in collateral have equal priority. No, first in time, first in right, unless it's a PMSI. The answer is going to be A here. Perfected will always be unperfected. Otherwise, it's first in time, first in right, unless we're dealing with a PMSI, a purchase money security interest. Which of the following is true regarding the debtor's rights in the after acquired property under Article 9 UCC, assuming the security agreement includes an after acquired property clause? The debtor has the right to acquire property free of any security interest. The debtor's rights in after acquired property are automatically subject to any security interest in the same type of property. Yes. The debtor's rights in after acquired property are subject to a security interest in the same type of property only if the interest is perfected. No. The debtor's rights in after acquired property are subject to a security interest in the same type of property only if the security interest is unperfected. I don't think it matters. I just think they're automatically subject if there's an after acquired property clause. Exactly. An after acquired property clause means that they'll automatically subject any new acquisitions to the agreement. Under Florida law, which of the following types of collateral is considered to be investment property? Shares of a stock, a debtor's interest in LLC, an account maintained with a broker-dealer, all the above. Those are all different types of investment accounts. Harrison approached Finance Co. for a loan of $60,000. Finance Co. was open to lending the requested amount with the condition that Harrison's grandfather's vintage art collection is used as collateral. Finance Co. seeks your legal counsel in relation to this planned transition. What step is mandatory for Finance Co. to establish an enforceable security interest in the collateral? Harrison must authenticate a security agreement, providing a clear description of collateral. Harry must file financial statement that offers a clear description of collateral. Finance Co. must take possession of collateral. Finance Co. must send Harry written confirmation saying that the art collection will serve as collateral for the loan. I think here we're going to have a security agreement to establish the attachment. Typically attached via security agreement, perfect via financing statement. Under Florida law, which of the following methods can be used to perfect a security interest in a deposit account? A deposit account. Control, right? You're not going to take possession of it. You know, you don't file a security agreement with the state. Recording a mortgage, definitely no. Obtaining control of the deposit account is, oh yeah, authenticating a financing statement would be the answer. That would be correct. I was like, A and C both look right, but no, it's not a security agreement. It's a financing statement. But if you have control of the deposit account, then sure, that would be a means of perfection. Which of the following is an example of PMSI? A security interest in inventory that is granted to a bank that has lent money to the debtor to purchase the inventory? Yes. A security interest in a motor vehicle that is granted to a car dealership that has sold the vehicle to the debtor and financed the purchase? Yes. A security interest in equipment that is granted to a manufacturer that has sold the equipment to the debtor and financed the purchase. See, financing the purchase, lending the money to make the purchase, all of them would constitute PMSIs because the collateral wouldn't be purchased without the loan. Under Florida law, which of the following methods can be used to perfect a security interest in a motor vehicle? So in Florida, you do have to note the lien on the certificate of title. That's a requirement for taking a security interest in a vehicle. That has to be noted on the lien on the vehicle, noted as a lien on the vehicle certificate of title. Which of the following is true regarding the priority of a security interest in a motor vehicle under Article 9? Okay, a security interest in a motor vehicle always has priority over other security interests in the same vehicle. No, a security interest in a motor vehicle has priority if perfected before other security interests in the same motor vehicle, provided none of the other interests are PMSIs. That's true. First in time, first in right, if they're not PMSIs. Solid. Who is typically the debtor in a secured transaction? The person whose favor security interest is created, yes. The person who has an interest other than security interest or other lien in the collateral, yes. The third party who holds a security over the collateral. Who is typically the debtor in a secured transaction? The person in whose favor a security interest is created, the person who has an interest other than a security interest or other lien in the collateral, the third party who holds a security over the collateral. Okay, the debtor is the person who is borrowing the money. So A is true. They have an interest in the collateral other than a security interest or other lien in the collateral, and a third party who holds a security over the collateral. Okay. I think about this one. I'm like nervous. I don't want to get it wrong here, but I definitely like the person who has an interest other than a security interest or lien in the collateral. They definitely have an interest in it for sure. And then the third party who holds a security over the collateral. So I'm trying to think that the third party who holds a security over the collateral, what exactly does that mean? And then also the person in whose favor a security interest is created, what exactly does that mean? I mean, I'm tempted to pick all the above here. But I know definitely B is a correct answer, right? I know B is a correct answer. I don't think C is a correct answer. And the person whose favor security interest is created, no, I think that's the creditor as well. I think it's B only. Yeah, tough one. So, right. The person whose favor the interest is created is the lender, not the debtor. And then C, again, it describes a secured party, not the debtor. Only B correctly identifies a debtor in a secured transaction. That was a tough one. In secured transactions or Article 9 of the UCC, the debtor is the party who owns or has rights in the collateral and borrows money or incurs an obligation that's secured by the collateral. The secured party is the creditor who holds a security interest, right? That's the lender, and that's the lender. Here is the borrower. The debtor is the borrower, which makes sense. Okay, what category of goods would a tractor used on a farm fall under according to UCC? Okay, it's a tractor used on a farm, so it's probably going to be equipment. I mean, a tractor could be consumer goods or inventory, but if it's used on a farm, I would argue it's equipment. Yeah. Under Florida law, which of the following types of collateral is considered to be general intangibles? Copyrights, patents, trademarks, all the above. It's got to be all the above as intangibles. What is an accession in the context of secure transactions? So accession versus commingling. Commingling means they're no longer identifiable, where accession means that it's still identifiable. So it refers to goods that are physically united with other goods in a way that doesn't change the identity of the original goods. Yeah, exactly. As opposed to commingling, where it's commingled. You can't identify it anymore. Think of a session like tires on a bike. You can still see the tires, but it's become attached to a bike. Under Florida law, which of the following types of collateral is considered to be equipment? Machinery, fixtures, farm products, or all the above. I would say machinery is the only one here that's going to constitute equipment. Which of the following is true regarding the perfection of a security interest in equipment under perfection is achieved by filing a financing statement? True. Perfection is achieved by taking possession. Perfection is achieved by taking control. Perfection is not possible. For equipment, you would typically file a financing statement to perfect. Under Florida law, which of the following types of collateral is considered to be fixtures? Machinery that is permanently attached to real property, definitely. Accounts receivable, no. Intellectual property, no. It's going to be, attached to real property, things that are bolted to the floor. Which of the following is true regarding the perfection of a security interest in fixtures under Article 9? We're going to have to file a fixture filing for fixtures. Fixtures require a fixture filing. Under Florida law, which of the following types of collateral is considered to be farm products? Crops that are grown, livestock, products of crops for livestock, and their unmanufactured states. All the above for sure. All of them would be farm products. Which of the following is true regarding the perfection of a security interest in farm products under Article 9 of the UCC? Perfection is achieved by filing a financing statement, for sure. Not by possession, not by control, and it's definitely possible. Just like equipment, you'll file a financing statement. Under Florida law, which of the following collateral is considered to be inventory? Goods that are held for sale or lease, raw materials, or work in progress. So I'm pretty sure for this one, it's going to be all the above, that we're going to have, goods that are held for sale or lease, raw materials, works in progress. All of them would be considered inventory if you think about it, right? They're all considered a form of inventory. What is the process by which a security interest is created? Attachment. You always create a security interest by attachment. You perfect, put others on notice by perfection. How long does an automatic temporary perfection last and perfected security interest for proceeds? So automatic temporary perfection to proceeds, I believe is going to be 20 days after attachment. So automatic temporary perfection and proceeds last 20 days after the debtor receives the proceeds. After that, the security interest must be perfected by other means to retain priority, usually by filing or control, unless an exception applies. In which scenario does automatic perfection occur? When the security interest is a PMSI in consumer goods, which perfects upon attachment. True. When the security interest is a PMSI in collateral that is not consumer goods and filing occurs within 20 days. Yes, you have a 20-day grace period. True. When there's an intermediate period of being unperfected. No, I think A and D or B are both correct here, that you have automatic perfection in consumer goods, and then you have a 20-day grace period for perfection in non-consumer goods. Linda and Sarah both claim a security interest in the same piece of machinery owned by Peter. Linda's security interest is perfected, but Sarah's not. Who's going to win? Linda, because it's perfected. Perfected versus unperfected. Perfected always wins. Michael defaults on his payments to Emma, who holds a security interest in Michael's luxury boat. Emma decides to repossess the boat but encounters resistance from Michael. Which of the following is the best course of action? Here, you're going to need a writ of replevin. If you can't take the boat without breaching the peace, then you would need a writ of replevin to get the sheriff to come and take it for you. Which of the following best describes the difference between accession and commingling? So accession means the goods are still identifiable, while commingling means that they're not identifiable. So accession refers to goods that are physically united in such a manner that the identity of the original goods is not lost, while commingling is when goods are integrated with other goods such their identity is lost in product or mass, right? Commingling, they've totally lost the identity, where accession, it's like a tire on a bike. Commingling, think about it, it's all mixed together. It's like concrete in the house. You can't really pull the concrete out. Sally sells the piano to Bob on credit and retains a security interest in the piano. Bob later retains a loan from Mike, giving Mike a security interest in the piano. Sally does not file her security interest. Who has priority? So Bob sells a piano to Bob on credit and retains a security interest. Bob later obtains a loan from Mike, giving Mike a security interest in the piano. So I'm going to say Sally because it's a PMSI, because Sally sells to Bob on credit and retains a security interest. So that would be a PMSI, where the money was used to purchase the piano itself. Which of the following statements accurately reflects the UCC standards for collateral description and security agreement? So the description of personal property must be specific and provide excessive detail. No, it just needs to be, reasonably identify the goods. Ultra generic terms such as all the debtor's assets are permissible. No. A reasonable identification of the collateral is sufficient, even if it's not specific, as long as it reasonably describes what's being identified. That's the standard for attachment. It needs to be reasonably identify the goods. In secured transactions under Article 9, when does a situation qualify as a pledge? So a pledge is someone who has rights in the collateral when they have possession of the collateral. So when it's created and they have possession of collateral, no, there's no security agreement. When oral agreement is made without the secured party having possession of collateral, no. When agreement, which can be oral, is made and the secured party has possession of collateral, yes. That's what a pledge is. It's when you didn't do a security agreement, you just took by possession and you had an oral agreement, then you would be considered a pledge in that situation. Which of the following constitutes a breach of the peace during a repossession event? The secured creditor enters the debtor's home without permission. The debtor politely refuses to hand over the collateral. The secured party informs the debtor of his intent to repossess. The secured creditor sends a written notice about repossession. I would say trespassing would constitute a breach of the peace. Which of the following is a true statement about the debtor's right of redemption under Article 9 of the UCC? A debtor can waive the right of redemption before default. A debtor can only exercise the right of redemption by filing a lawsuit. A debtor can exercise the right of redemption by paying the full balance due on the promissory note, together with fees and assessments accruing thereby. It's the same thing as in property. When you have that equitable right of redemption, if you come up with the money before the sale of the collateral, then you can redeem it, right? When does attachment occur in a secured transaction? When the debtor's rights in the collateral, when the creditor gives value for the transaction, upon the execution of a valid security agreement. It's going to be all three of these. So it would be the later of the above events. When the last of those three events happens, they give value, they have rights, and they have a security agreement. How is security interest in automobiles typically perfected? So remember, we have to note it on the certificate of title, right? By filing a security agreement with the state, by indicating security interest on the certificate of title, yes. By possession of the automobile by the creditor, no. By endorsement of security agreement, no. We have to actually note it on the certificate of title. How does the UCC allow for collateral description in a financing statement? So financing statement. Ultra generic terms can be used to provide maximum clarity and specificity. The collateral must be described in the same manner as security agreement, no. They can provide a general description of collateral using ultra generic terms. Descriptions such as all the assets are not permitted. They are. So C is true here because you can use all of their assets. You can use ultra generic terms. You don't have to use them, but you can use them, whereas you cannot use them in a security agreement. Which of the following statements accurately describe the parties involved in a secured transaction governed by Article 9? The creditor is the person who must pay or perform the obligation secured by the security interest. The obligor is the person in whose favor the security interest created under the security agreement. The debtor is the person who has an interest other than security interest in the collateral and is typically also the obligor. The debtor is the person who must pay or perform the obligation secured by the security interest. So for this one, we're trying to think who is the debtor, right? The debtor is going to be the person who has an interest other than the security interest in the collateral, and it's typically the obligor. They're the ones who are obligated to make payments, and their interest is their collateral. but they don't have a security interest. They have a actual interest in it. So the debtor has an interest in the collateral, also the obligor. The obligor is the obligation to pay or perform. They're not always the same parties, but they usually are. The secured party, the creditor, receives the security interest and lends the value, right? So that's the difference between the debtor, the obligor, and the secured party. And typically the debtor and the obligor are the same parties. Under Florida law, which of the following is true regarding the priority of security interest in collateral? A perfected security interest has priority over an unperfected security interest. True. A security interest as perfected by filing a financing statement has priority over security interest. No. A PMSI in non-consumer goods has priority even though security interest are perfected and the PMSI is not. No, because you have to perfect the PMSI and non-consumer goods within 20 days. A perfected security interest has priority of a second in time PMSI in a consumer good. Perfected security interest has priority over a second in time PMSI in a consumer good. That's not true. It's going to be A. A perfected security interest has priority over an unperfected security interest. Which category of collateral includes goods used primarily for personal, family, or household use? Equipment, inventory, consumer goods, or accounts. Consumer goods, right? Personal, family, or household use would be consumer goods. Under Florida law, which of the following is true regarding the rights of a secured party upon default by the debtor? The secured party may repossess the collateral without judicial process if repossession can be done without a breach of the peace. That's exactly true. You can repossess. If you have to breach the peace, you would need to seek a writ of replevin. Under Florida law, which of the following is true regarding the disposition of collateral by a secured party after default by the debtor? The secured party may dispose of the collateral by public or private sale as long as the sale is commercially reasonable. That's true. It has to be commercially reasonable. Yeah, that's true. Public or private sale as long as it's commercially reasonable. What's the purpose of perfection in a secure transaction? To ensure that the debtor's rights in the collateral, to create a security agreement between the debtor and the creditor, to provide constructive notice of third parties of the secured party's priority. That's going to be the purpose of perfection, to provide notice to others. How is possession relevant to achieving perfection in a secured transaction? It serves as a method of perfection for tangible property. It establishes priority over other secured creditors. It's required for all types of collateral. It's required for automatic possession. No, it's a method of perfection for tangible property if you could possess it. Under Florida law, which of the following is true regarding the right of a debtor to redeem collateral after default? The debtor may redeem the collateral at any time before the secured party disposes of it by paying the amount of debt plus expenses of the secured party. That sounds just like a question we did earlier, that you have a right of redemption, just like in mortgage law, where if you come up with the money before the sale and any additional expenses incurred, then you can redeem the property. In a conflict between two unperfected security interests, which security interest will prevail? The one, if they're both unperfected, it'll be first to attach, right? First in time, first in right. Under Florida law, which of the following is true regarding the liability of a secured party for wrongful disposition of collateral? A secured party that wrongfully disposed of collateral is liable to the debtor for any damages resulting from disposition. True. A secured party that wrongfully disposed of collateral is liable to the debtor for any damages resulting from disposition, but only the debtor can show that the disposition was willful. No. A secured party that wrongfully disposed of collateral is not liable. No. A secured party that wrongfully disposed of collateral is liable to the debtor only if they can show his intention. No. They can be liable for wrongful disposition as a matter of course. Which of the following is not typically a type of tangible collateral under Article 9? Okay, real property, right? It doesn't cover real property. It covers farm products, equipment, consumer goods, and inventory, but not real property. Real property would be under mortgage law. These are some tough questions. I mean, I'm telling y'all, of these 50 questions and then the 10 fundamental ones we have as well. I mean, the fundamental ones are really good, these 10. It's going to be simple. If it's secure transactions or commercial paper questions on the Florida bar, it's going to be the simplest of these questions. So if you got some of the hard ones wrong or confused by them, don't worry. These are simple subjects on the bar exam. Business entities will be more in depth. They could ask, about tip or tip B. They could ask about blue sky laws, business judgment rule, piercing the corporate veil. There's a lot of different directions they could go with business entities. With secure transaction, it's going to be attachment, perfection, right, and priority. It's going to be very simple subjects. All right, let's try commercial paper. So which of the following best describes the main difference between a note and a draft under UCC Article 3? A note involves two parties while a draft involves three parties. That's a fact, right? A note is a two-party instrument, a draft is a three-party instrument. Which of the following instruments is negotiable under Article 3 of the UCC? A check payable to Russell with a condition for payment? No. A promissory note payable to bearer with principal amount to be determined at a later date? No. A CD payable on demand to Laura? Yes. A promissory note payable to bearer that requires bearer to donate half to charity? No. Remember, a promissory note, or let's say a negotiable instrument, what it must be to be negotiable is a signed, written, unconditional promise to pay a fixed sum of money with or without interest on demand or definitive time to order a bearer with no additional undertakings. This one has a condition, this one's not a fixed amount of money, and this one has an additional undertaking. So it'd have to be C here. That's the only one that would be truly negotiable. Michael is the holder of a negotiable instrument. He wants to become a holder in due course. Which of the following is not a requirement for him to become a holder in due course? So remember, for value in good faith without notice. So for value in good faith without notice, you don't need to obtain possession to become a holder. I moved too quickly. I'm sorry about that. Um, Yeah, of course you need to be a holder. You need to have possession of it. You don't need to give notice to the prior holder. You need to take without notice. So I was moving a little quickly, and this will happen to the best of us, but I was just saying the rules. For value in good faith without notice. So you don't have to actually give notice to the prior holder. You have to take without notice and then obtain possession for sure, because you have to be a holder, and you're not a holder if you don't have possession. Sorry about that one. Which of the following defenses is not available to a maker of a negotiable instrument against a holder in due course? Infancy, duress, fraud on the inducement, or illegality. So it's not available to a holder in due course. It'll be fraud on the inducement. Fraud on the factum is a real defense that's available to a holder in due course, but fraud on the inducement is a personal defense that's not going to be available. Russell is the holder of a negotiable instrument payable to the order of Laura. Russell transfers the instrument to Brian by assignment. Which of the following statement is true about Brian's rights in the endorsement? So Brian's a holder in due course. We don't know. Brian has the same rights as Russell. Brian has no rights. Brian has more rights. So have the same rights. When you transfer an instrument, you'll transfer the same rights. John told his son Tim that he was worried about Tim's poor grades in school. To motivate Tim to improve, he promised to give Tim $1,000 if he made the honor roll for the upcoming semester. He wrote a note saying, I promise to pay him $1,000, provided that he makes the honor roll for the upcoming semester. This is not going to be negotiable because there's a condition, right? So the promise to pay is conditional, so it's not a negotiable instrument. That's probably the most likely thing they're going to test, is there's going to be a condition to negotiability, which would make it not a negotiable instrument. What's the primary purpose of a negotiable instrument? To facilitate the transfer of money or payment, for sure. Under the UCC, which of the following could potentially be recognized as a signature? Anything could be a signature. We're not going to look at the legitimacy of a signature as long as it's not under question. Under the UCC, which of the following warranties does a transferor make to a transferee when transferring a negotiable instrument that has not been materially altered, right? That's going to be a transfer warranty. Michael receives a promissory note payable to the order of Andrew. Michael transfers the note by saying pay to the order of Brian. This is going to be a special endorsement because it's specially to Brian. So you can think of special endorsement specially to a particular person. Which of the following is not a requirement for an instrument to be considered a negotiable instrument under Article 3 of the UCC? It must be signed by the maker drawer. It must contain an unconditional promise. It must be payable at a fixed or terminal date. It must be payable to the order of a specific person or to the bearer. All true. Is not a requirement for it to be considered a negotiable instrument. It must be payable on a fixed or determinable date. No, because it could also be payable on demand. I had to think about that one. But signed, written, unconditional, promise to pay a fixed sum of money with or without interest on demand or a particular time to order bearer no additional undertaking. So this one, it doesn't have to be a fixed or terminal date. It could also be on demand. Andrew is the holder of a negotiable instrument. In order to negotiate the instrument, what must he do? Transfer possession, endorse the instrument, transfer and endorse. It's notify the prior holder of the transfer. Okay, this question I'm going to say is a little bit ambiguous because if it were bearer paper, it would just be transfer possession. If it's order paper, it would be possession and endorsement. So assuming this is order paper, it would be C. Yeah. Because it says to payable to order. right, a little bit ambiguous, but just learn that, and I'll probably go back and doctor up this question a little bit to make it more clear that possession is sufficient for bearer paper, but for order paper, you need possession and endorsement. Which of the following defense is available to a maker of a negotiable instrument against a holder in due course? So fraud in the factum is available, whereas these three are personal defenses. They're contract defenses. Fraud in the factum is a real defense. So differentiate fraud in the factum versus fraud in the inducement. Fraud in the inducement is a personal defense not available to holders in due course. Fraud in the factum is a real defense that you could still bring against a holder in due course. Russell's a holder in due course of a negotiable instrument. What does it mean to be a holder in due course? That he takes for value in good faith and without notice of any defects. So it means that he's protected against certain defenses and claims, right? He's protected against all of the personal defenses. Under UCC, which doctrine allows a transferee to obtain the rights of a transferor to enforce a negotiable instrument, including the rights of a holder in due course? This would be the shelter doctrine. You can take shelter in the upstream status of a holder, including a holder in due course. So that's true. If someone takes for value in good faith without notice and then gives it to the next person, even though the next person was given the instrument and they didn't take it for value, they would still be able to take shelter in the upstream status of the holder in due course. Which of the following statements is true about a holder in due course? They must give value for the instrument. They must take in good faith. They must have no notice. This is the question that I clicked quickly on the other time. Yes, all those three things are true for value in good faith and without notice to become a holder in due course. Michael receives a negotiable instrument from Andrew, who's the maker of the instrument. Andrew asserts a personal offense against Michael. Which of the following is correct? A personal offense will not hold if Michael is merely a holder. No. A personal offense will hold against Michael as a holder in due course. No. It will not hold if Michael is a holder in due course. Remember, holders in due course take free from the personal offenses and are only subject to the real defenses. Which of the following is an essential element of negotiability for a negotiable instrument? It must be written on pink paper. It must be payable with specific currency. It must have a floating maturity date, or it must be signed by the maker or drawer. It's got to be signed. I mean, it could be any currency. It doesn't have a floating maturity date. It doesn't have to, and it doesn't have to be written on pink paper. It just needs to be a signed, written, unconditional promise to pay a fixed sum of money with or without interest on demand or definitive time to order or bear with no additional undertaking. What does it mean for an instrument to be payable to order under Florida law as interpreted from Article 3? So payable to order means that it's to a specific person named on the instrument. That's order paper. Bearer paper is just possession. Order paper is to a particular person. So Brian receives a check payable to the order of Russell. Brian endorses a check by writing pay to the order of Laura without recourse. So what type of endorsement is this? It's not a blank because it's obviously not a blank, and it's not special because we talked about special endorsements where special endorsements are specifically identified to a particular person. So it's either going to be a qualified endorsement or a restrictive endorsement. But here it's not going to be a restrictive endorsement because it's not restricting anything. It's going to be qualified because it's qualifying without recourse. So when you see without recourse, that's a qualified endorsement. When you see to a specific person, that's a special endorsement. When you see for deposit only, that's a restrictive endorsement. Under Article 3 of the UCC, which of the following is not a requirement for presentment of a negotiable instrument? So remember, negotiable instruments come with transfer warranties and presentment warranties. At a reasonable hour on a business day, to the person primarily liable is all true. It doesn't have to be made by a holder in due course. Anyone could present a negotiable instrument, even if they're just a regular holder. They don't need to be a holder in due course. Which of the following actions of Andrew to make a negotiable instrument constitutes a real defense? So real defenses, he claims he's fraudulently induced. No, not fraudulent inducement. It was materially altered after he signed it. Yes, that would be a real defense, right? Because it's fraud in the factum, not fraud in the inducement. Russell endorses a check for deposit only, like we just talked about. For deposit only would be a restrictive endorsement. Laura is a holder of a negotiable instrument that contains an ambiguous term. How should it be construed? In favor of the maker drawer, in favor of the holder, in favor of the party who did not create the ambiguity. Yes, when there's an ambiguity, you'll analyze it in favor of the party who did not create it, right? If it's to add an additional term, and this is contract law, then it'll be whatever's reasonable. But if it's an ambiguity, it'll be enforced in favor of the party who did not create the ambiguity to protect innocent parties. Michael is the holder of a negotiable instrument that I received from Andrew, who has a personal offense against the instrument. Brian transfers the instrument to Brian, who takes the instrument in good faith and for value without notice of the claims, which is true. So Brian is a holder in due course, and the personal defenses will not be available. So Brian's a holder in due course and takes free of Andrew's personal defense. That's going to be true, right? Holders in due course take free of the personal defenses. John writes a check to Sarah for 500. Who's the drawer? John's the drawer, right? Because John's the one who drew the check up, right? Checks are three-party instruments. They have a drawer and then a drawee/payor, which is the bank, and then a payee. Where a promissory note is a two-party instrument that has the maker and the payee. When does dishonor occur? Dishonor occurs when proper presentment for payment is made and payment is refused. That would be known as dishonoring. The bank isn't paying you. Which of the following statements is true about the liability of a drawer on a check under Article 3? The drawer is primarily liable. Yes, the drawer's, oh no, it's a check. The drawer is not primarily liable. They're going to be secondarily liable because the primarily liable party for a check would be the bank, the drawee/payor. So for this one, the answer is going to be secondarily liable because the bank is primarily liable, the drawer is secondarily liable. Think about that. In a three-party instrument, the drawer is secondary liable, the intermediary party, the bank, is primarily liable. In a two-party instrument, the maker is primarily liable. Laura is the holder of a check drawn by Andrew, payable to the order of Brian. Laura endorses the check and transfers it to Michael. Under the UCC, which of the following statements correctly describes Laura's liability in the scenario? So Laura's the holder, and it's drawn by Andrew, payable to Brian. So Laura is primarily liable, no. Laura's liability is not affected, no. Laura, as the endorser, becomes secondary liable if it's dishonored by the drawee. That's going to be true. The endorser is secondary liable on a negotiable instrument if a drawee dishonors a check, refuses to pay. And an endorser is kind of like a drawer. They're going to have secondary liability, whereas the drawee, the bank, will have primary liability. Under Florida law, which of the following statements are true regarding a post-dated check? A post-dated check has no effect. You can cash it in immediately. So it's a negotiable instrument, and it can be negotiated before the date on the check. That's not an effective measure to post-dated check. As long as someone has, possession of it and it's ordered to them, or it's possession and it's bearer paper, they could cash it in immediately or transfer it immediately, even if it's post-dated. Michael's the maker of a promissory note they issued to Andrew. Andrew negotiates the note to Brian, who's a holder in due course. Michael has a real defense on the note, against the note. What is true? So the real defense is valid, even though that Brian's a holder in due course. Remember, we can still bring real defenses against holders in due course. We just can't bring personal defenses. Which of the following actions required for an instrument to be considered dishonored under Article 3? So presentment. If you present it, then it's going to be, which of the following actions required for an instrument to be considered dishonored under Article 3? So you definitely need to present it. And I think that's the best answer, right? Yeah, presentment. If you present it, then that means that it's considered dishonored if they don't pay. Notice of dishonor is typically required after dishonor occurs in order to hold endorser secondary liable, but it's not necessary to trigger dishonor itself. Tough question. Under Article 3 of the UCC, a promissory note is an unconditional promise to pay a fixed sum of money with or without interest, right? As simple as that. That's we've been reinforcing that through this lecture. Signed, written, unconditional promise to pay a fixed sum of money with or without interest on demand or definite time to order bearer with no additional undertaking. Laura is the holder of a negotiable instrument that has been dishonored. Which of the following parties can she sue to recover on the instrument? Anyone can be sued, right? The maker or drawer, right? They're going to have secondary liability. The drawee, primary liability. A prior endorser, secondary liability. So you could sue all the above and potentially collect. Which of the following parties is primarily liable on a check under Article 3 of the UCC? Like we just said, primary liability for a check would be on the drawee, which would be the bank. Everyone else here would be drawer and endorser secondary liable. And then the payee, they have no liability unless they later endorse it. Michael transfers a negotiable instrument to Andrew without endorsement. Which of the following is true? So assuming that this is order paper, and this is kind of ambiguous like the earlier one I talked about, because what if this was bearer paper? But if it's order paper, then Andrew would just be a transferee. If it was bearer paper, Andrew could be a holder, but here we assume it's order paper. I'm just assuming. So I would just be a transferee because I don't have the rights to enforce it, right? So for this question and the other question, I'm going to clarify in the question that it's order paper. If it's order paper and you're merely in possession, you're a transferee. If it's bearer paper, you would actually be a holder. According to UCC Article 3, who can enforce a negotiable instrument? The person who originally drafted the instrument, a holder, a non-holder in possession with the rights of a holder, or a person not in possession but entitled to enforce. Yeah. A holder or someone who has the rights of a holder is the one that could enforce the instrument. Under Florida law, which of the following actions by a holder constitutes a conversion of a negotiable instrument? So presenting the instrument for payment, obtaining payment, negotiating with a third party, or obtaining payment without proper authorization. Yeah, that would be conversion, obtaining payment without proper authorization. Where's the rule for a stop payment order? Stop payments are binding for 6 months, and oral stop payment order lapses after 14 days. That's true. Stop payment orders are going to last 6 months. Under UCC Article 3, what's the liability of partners who sign a negotiable instrument jointly? So they're going to have joint and several liability, meaning either one can be sued for the entire amount. So yeah, if you parties who sign a negotiable instrument jointly are jointly and severally liable. Which of the following describes a promissory note under UCC Article 3? A promissory note, an order by one party for a second party to pay money to a third, a promise by one party to pay money to another party. I like that. A written contract outlining terms of a loan, or legal document recording the existence of a debt. No, it's a promise by one party to pay money to another. Which of the following is not a requirement for a holder to give notice of dishonor under Article 3? It must be given within a reasonable time. It must be given by the holder, a person acting on behalf of the holder. It must identify the instrument that has been dishonored. It must be given by a holder in due course. No, it could also be by a holder or a person acting on behalf of the holder. It's not necessary that a holder in due course. Under UCC Article 3, who is a person that writes the check? I mean, a drawer. They draw the check, right? Under UCC, which of the following is a valid form of endorsement? A signature alone, a signature with the words, pay to the ordered, a special endorsement without recourse, which would be a qualified endorsement, or all the above. Definitely all the above would constitute endorsements, right? Special, qualified, a blank endorsement would just be a signature alone. And then remember, there's also a restrictive endorsement, which would be for deposit only. Under UCC, Article 3 is a promise or order conditional if it requires a counter signature of a specimen signature. No, it's not conditional merely because it requires a counter signature of a specimen signature. According to UCC Article 3, which of the following is not a transfer warranty? So is entitled to enforce the instrument? Yes. All signatures are authentic and authorized? Yes. It has been altered? No, it's that it has not been altered. And then they have no knowledge of any insolvency proceeding commenced against it, right? So remember, transfer warranties and presentment warranties, the thing is valid and it hasn't been altered. Which of the following is not a reason for discharge of an instrument under Article 3 of the UCC? Payment, cancellation, material authorization of the instrument, or presentment of the instrument. So which one of these would not be a reason for discharge? Well, I would think that payment definitely, cancellation definitely, material alteration definitely. Presentment, I mean, just because you presented it, I don't think it has been discharged. It's presentment plus payment would probably be the answer. Yeah. Merely presenting the instrument doesn't discharge the obligation. It's just procedural. So payment, cancellation, and material alterations can discharge, but presentment alone does not. I mean, presentment plus payment would discharge, but not merely presenting. According to UC Article 3, which of the following statements does not accurately, correctly describe presentment warranty? The warrantor should be or should have been a person entitled to enforce a check. True. The check should not have been materially altered. True. The warrantor should inform the holder if the check bounces. And then for remotely created consumer checks, the account holder must have authorized the issuance and the amount of the check. So D is definitely true. A is definitely true. B is definitely true. I don't think C is a presentment warranty that they inform the holder the check bounces. I mean, they should, but it's not a presentment warranty, right? It's not a presentment warranty, yeah. And then 49, which of the following statements is true regarding a negotiable instrument that's payable to bearer? So bearer can be negotiated by delivery alone. We don't need an endorsement. That's true. And then finally, according to UCC Article 3, which of the following does not constitute value for becoming a holder in due course? Acquiring a security interest in the instrument, trading a negotiable instrument for another instrument, making an executory promise to fulfill a future obligation, or taking the instrument as payment for an antecedent debt. So for this one, what does not constitute value for becoming a holder in due course? I would say that a future obligation, right? It has to be a current obligation, or a former debt that you're paying off, but not a promise to fulfill a future obligation. So to qualify as a holder in due course, one must give value, take the instrument in good faith, and without notice of certain defense or claim. Executory promises, promises to act in the future, do not count as value, but things like paying money, exchanging instruments, or accepting payment for an existing debt due. So not my finest hour. I got this question wrong, but only because I was reading too quickly, and I picked the notice answer, but it was a trick. So to be a holder in due course, you must be a holder for value, take in good faith, and take without notice. And then there was two questions I saw that I want to clarify that it's ordered paper, not bearer paper, because bearer paper can be transferred via possession alone, whereas order paper requires possession plus endorsement. If you're watching this, I highly recommend you do at least the fundamental review questions. I feel like these 10 questions are going to be pretty spot on to what you're going to have to answer on test day. And the same thing with the business endies. There's 15 fundamental review questions. We're here to help. I think that this multiple choice Q bank is really good at quickly and effectively reinforcing the laws that you need to know on test day. And then we have practice exams and final exams, 100-question exams, and these FBBE practice questions, which are the questions that have been disclosed that include explanations, as well as a mini quiz review and a mixed question review, and then 50 questions for each subject plus 10 or 15 depending on the subject. And then we even added 10 judicial procedure fundamental questions. So I'm a really big fan of this Q bank. I'm actually going to spend 5 or 10 minutes right now doctoring up a few of the things that I saw to make it even better. But I made it a point over the last few years to come out with the Florida multiple choice Q bank. We were actually the first company to come out with a question bank like this besides the big box companies. I know we might not have the best marketing team out there. I focus more on operations than on marketing, but this is the original Florida multiple choice Q bank. It's only getting better with time, and it's a must have for the Florida bar exam. We also have a MBE Q bank, and you could get the Florida multiple choice and MBE bundle together. I would also say it's the best MBE Q bank out there because of the way that we divide it by subtopic and the way that we have final exams and just really good things that you can work on. And the questions, we have the best diversity of questions and the best explanations, and they all come with key takeaways. And like I said, what's really cool about it is like we have easy concepts questions, then we have questions divided for subtopic, and then we have mixed question reviews, and then we have final exams, a 200-question final exam. So I'm a really big fan of the Birdie Q bank. I highly recommend that you click the link below and purchase it and start, going after these questions and trying to get them all right. And if you get some wrong, you can redo the quiz and get them all right. And that process of repetition and reinforcement will go a long way on test day. I know that the Florida bar exam is a tough test. I know that the Florida multiple choice section is very tough. And I know that business endies, secure transactions, and commercial paper is about as tough as it gets. And I want to give students all the resources they need to succeed. Shoot us an email, go on our website, try to find out what we have to offer. We have outlines, we have cram guides, we have questionnaires, and we offer one-on-one tutoring for all these subjects. I do a complete course. I do an essentials course at the beginning in November and April, and then I do a boot camp the 2 weeks before the exam. And all these things add up to a really great track record of success for my students. So thank you all so much for watching. I hope you got some value out of this, and best of luck on test day. I'll be there in Tampa. You can always find me at American Social the Wednesday night after the exam. And, I'd love to cheers to hard work, and I'm wishing you all the best on test day. Thank you so much, and have a great study experience.